You're watching Economics Amplified, the latest thinking on the biggest issues from UChicago's Becker Friedman Institute.
Okay, well, I think we'll get started. Try to keep this a little bit on schedule. Thank you all for coming. The Becker Friedman Institute, as you know, sponsors these talks occasionally, and it's a way for us to display some of our finest scholars who are working at the frontiers of research, but also do things that are policy relevant. Now, one of the things about the Becker Friedman Institute that we always talk about is that while the work is all policy relevant, much in the spirit of Milton Friedman, it doesn't necessarily have immediate relevance. And what I mean by that is, if you think about Milton's work, back in the 50s and 60s, those of you who have read Capitalism and Freedom, these ideas were amazing, really profound, but it took a really long time for them to make their way into policy. And at the time, they were heresy. Stuff like an all-volunteer army, vouchers for schools, negative income tax, all of the things that are now part of the law were at the time just, people thought it was just crazy. The same thing is true of Gary's work. If you look at some of the things that Gary did early on, particularly the stuff, the ideas that I always think about are the points that had to do not with the family in his treatise of the family, but it certainly had to do with the family. That was his stuff on demography and the economics of fertility. Here's a guy who comes out and talks about children as a consumer durable. Now, who other than an economist would think that you could even do that with a straight face? Gary didn't even think it was an odd way to characterize kids, But the point was that his work was actually, it was not only profound, but it had an enormous effect on policy, because now if you look around the world and you look at NGOs and other organizations, UN organizations like this that are thinking about how do you control population growth rates, the basic idea is you educate girls. Where does that come from? Well, it really comes from Gary's work of the late 50s. And again, it took some time for that to make its way into the literature and make its way into policy. But it's extremely important work. And most of the kinds of things that you hear coming out of the Becker Friedman Institute are of that sort. They're things that at the time may appear somewhat heretical, but eventually become part of the policy rhetoric, and some of them even become law. So that's the way we like to do work. We want to do what's right, what's fundamentally serious and intellectually respectable and sound, but also that has policy relevance, even if it doesn't happen today or tomorrow. It will happen. So today, we have a perfect example of that in Pierre-André Chiappori, who is, I would say, the premier theorist in economics of the family, and I say that with some trepidation because, of course, Gary started the field. But there's just no question that when you think about formal economic theory having to do with family economics, Pierre-André is the guy who's done the most and the most important work in that area. So we're delighted to have him. He has a very distinguished background, very distinguished career. Much of it is in French, so I actually speak a little French, so I'll give you a little bit of it. He did his studies at École Normale Supérieure in mathematics and economics. He was then the director of an institute in France, but in 1997, the University of Chicago discovered him. And actually, it was Gary who discovered him and found that he was, again, as I mentioned earlier, he was doing the most profound and important work in economic theory in the family. And so he was brought to the University of Chicago, accepted the offer, came to the Department of Economics, where he was a professor for many years, was an editor of the Journal of Political Economy. He's currently at Columbia, but spends a lot of time still at the University of Chicago. We see him, I don't know, a few weeks a year at least every year, and has been a fellow of the Becker Friedman Institute for the past few years, and hopefully for many years to come. He's a fellow of the Econometric Society and many other societies, including one of which I was the personal founder of, so it's a Society of Labor Economists. And in 2010, he was awarded the Grand Prix Zerili Marimo by the French Académie des Sciences Morales et Politiques. So obviously a very distinguished background. He has over 100 published articles. He has five books, the most recent of which is The Economics of the Family, edited by Cambridge University Press, coming out in 2014. I guess, is it out yet, or is it still forthcoming? Still, yeah, that's how those things always are. Being printed even as we speak. But he also has a book with Christian Gollier on insurance, a theoretical analysis and policy implications. And those two books are particularly relevant to today's talk because when you think about healthcare, obviously the most important issues that are associated with that are things involving the family, but also things involving insurance. So Pierre-André is going to give us his wisdom on that, and we're delighted to have you here, and thank you very much for speaking on this extremely important and chaotic topic.
Thank you very much. It's a real pleasure to be here. Let me start with a caveat, or maybe I should call that an apology. I'm going to talk about health, obviously. I'm not a health economist. So in particular, there are plenty of aspects which are very important, very relevant, and I'm not going to talk about. For instance, I'm not going to talk about cost. And as you know, cost is an important dimension of this debate. What I'm going to do instead is actually following an old Chicago tradition that Eddie was alluding to, look at the problem from a different perspective. So I will look at this, not as a health economic, but as an insurance economist, and as someone who has spent years working about risk. Now, in particular, the one thing I want to concentrate on is what was probably the main justification for the health insurance reform, which was decided that in the US there are something like 50 million people who are not covered by insurance, and the ACA was seen as a way to include those people in some kind of insurance coverage. And I think this statement is partially flawed for two reasons. The first one is, among those 50 million people who are not covered, there are extremely different situations. There are people who just don't want to be covered. You know, if someone who is competent, who is well-informed, chooses not to buy insurance coverage for any kind of rational reason, it's not completely obvious that the government should force him to do so at least for his own good. There are other justifications linked to the structure of the market that I'm going to talk about later on, but at least for his own good, it's not completely compelling ex ante that we should do that. On the other hand, there are people who are not covered because they cannot get the coverage. And here, I think there are very serious issues that I'm going to mention. But there is the other side of the coin, which I think is even more important. When you're saying 50 million people are not covered, you're implicitly assuming that 250 million are covered. And what I'm going to try to show you is that it's probably not the case, or at least not in if we give to the world covered by health insurance the kind of meaning we would like to give it. There are plenty of people who are statistically covered, so in the statistic they would appear as being covered, but in practice they are very far from having what we would call a serious coverage. And I think that's one of the, if I was asked, what's the main weakness of the pre-ACA healthcare situation in the US, that's exactly the point I will emphasize. Now, I will be a bit more specific in a minute. I recently wrote a paper with a lawyer. So not only I'm talking about health without being a health economist, but I'm going to talk about legal issues without being a lawyer. But my co-author is a very distinguished lawyer. And one thing I loved with working with lawyers is that they have cases. And you know, cases, you got a real situation and you need to do some kind of general perspective on it. And then you have to come back to the case and make a decision or recommend a decision. Now, here is an interesting case. It's a very well-known case in this literature, McGann versus H&H Music Company back in the mid-80s. McGann is an employee of a very small firm. H&H must have 5 or 6 employees, and he's diagnosed with AIDS. He's covered during 1 year, which was a bit less than 1 year, and then the contract has to be renewed, and the employer changes the term of coverage. And in the new contract, there is a cap on the lifetime coverage, and the cap is $5,000. Now, $5,000 is a few weeks, maybe a few months of treatment, right? So essentially, what this meant is that McGann, all of a sudden, had to pay out of his own pocket for the treatment, and he lost everything he had. He died, eventually, just because in the mid-80s, an AIDS diagnosis was something like a death sentence, but before that, he lost everything he had. And he died with a negative equity. He had huge debts vis-à-vis the hospital. Now, he sued for discrimination under the ERISA. The case went to court, and the court decided that there was no discrimination. And from a legal point of view, I think the argument of the court is perfectly clean and sound. The court said, had the employer discriminated in the sense of offering one particular contract to McGann and a different contract to everybody else, that would have been discrimination, and that would have been illegal. It was not the case. The same contract was offered to everyone. Turns out that the contract that was offered to everyone had this kind of very specific feature, but, say the court, what ERISA regulates is not the actual terms of the benefit, but just the way it's administered. So whatever the terms of the contract, if it's administered in a non-discriminatory way, in the sense that it applies to everyone, there is no discrimination, and it's perfectly legal. And I think from a legal point of view, it's perfectly so. Now, let's look at this case, and let's think about this case as economists, which is, exactly what the tradition of Milton Friedman and Gary Becker tells us to do. So let's put first ourselves in the shoes of the employer. I know nothing about the employer, and I don't know if he had some prejudice against, if he was homophobic, or if he had a prejudice against gay people or whatever. But the crucial thing is we don't need any assumption like this of a bias to understand what he was doing. From an economic point of view, his decision was perfectly rational. The premium charged by the health insurance company providing the coverage increased a lot, and the cost might have been unbearable. So if you buy something and the price of this something is multiplied by a factor of 4 or 5, it's not irrational to switch to something else. Now let's look at the same situation from the insurance company perspective. Again, there is nothing unexpected here. The business of insurance is about pricing the risk in proportion to the risk that's covered. All of a sudden, the level of the risk is much higher. The premium should go up as well. It's 1-year contract, so there is no issue of commitment. You renew the contract each year, and it might be that I didn't check, but it might well be the case that there is no reason to believe that the insurance was discriminating by overcharging or anything. The insurance was charging the fair price, just that the fair price has been multiplied by a factor of 4 or 5, just because the risk and the expected cost had been multiplied by the same factor. So from both sides, we see something like economics as usual, business as usual. Now, let's put ourselves in the shoes of the patient. Essentially, the story is quite different. McGann thought he was covered. He had house insurance covered. And in our statistics, he would be among the 250 million who are covered. But in fact, he was not. Essentially, whenever he had a big problem, he discovered that he stopped being covered within months. Of course, what's particularly nasty here is that when he discovered that, it was too late to look for a substitute. Too late to go on the market and try to buy health insurance coverage by himself because he had a pre-existing condition. And any kind of insurance company would charge him a premium reflecting his pre-existing condition, reflecting his high expected cost, meaning that there was no way to escape this kind of situation. Okay, so what do we learn from this case? The first thing is what we mean by health coverage is ambiguous. What about caps? Would you say that you're covered if you're covered by a contract which has a cap of $10,000? Let me give you an anecdote. A few years ago, a student of mine was writing a PhD dissertation at Columbia on a topic which is personal economics. Now, personal economics is a subfield of labor economics, which was pretty much invented by Eddie here. What this student was doing, which is the kind of approach that was pioneered by Eddie, is you go to firms, you look very carefully at their data, and you try to understand the nature and the dynamics of the contractual relationship, looking at the data of the firm itself. So since my student was working on this, I spent quite a long time talking with the employer. The guy was the CEO of a company who had call centers. So he had several call centers. The data were magnificent. It's the few data in which you can observe performance because it's easy to record and so on. And during the discussion, I asked him, do you provide health insurance to your worker? He said, yes, of course. And I asked, is there a cap? And he said, yes, $10,000. And I say, well, that's not very much. And he told me the following story. He told me when I started this business, I was sort of, naive or starting, and so I was much more generous. I gave a plan that was offering a cap of 500,000. This nearly cost me, nearly got me into bankruptcy. Within a year, no less than 3 of my employees reached the ceiling. Retrospectively, the guy realized that the people had chosen to work in this firm just because of the health insurance coverage. It's the kind of job. Think of a call center. You don't need any kind of special skill. You need to speak English decently, and you need to learn a few things. It's not very exciting. It's not very well paid. But if it comes with a 500,000 cap on the coverage, and you know that you have a very serious pre-existing condition, it could make a lot of sense. My point here is that the 10,000 cap is not a reflection of someone who's particularly stingy or exploiting the workers. It's really the logic of the market that can push you very much in this direction. And again, what about the long term? So there are people in my 250 million covered American, either were covered with a cap which is very low, anything like you better not need an organ transplant, an open heart surgery, or even a few days in an intensive care unit with this kind of cap. And of course, there is the long term, the McGann effect, that you might believe that you're covered and lose your coverage the following year. There is nothing exceptional. The McGann case is a bit symbolic. But there is what I used to call the cancer then layoff situation. Worst case scenario, you're diagnosed with cancer. 6 months later, you lose your job. Of course, if you are fired because of the cancer, that's illegal. But you say you lose your job just because your employer goes bankrupt. Now you're on the market trying to find a new health insurance coverage with a pre-existing condition. There is nothing unbelievable or exceptional in this kind of situation. If I was, again, if I was asked what was the main weakness of the pre-ACA situation in terms of health insurance coverage in the US, it's not so much the 50 million people, it's the fact that the number of the 250 million were actually facing this kind of risk. And that, I think, I will be a bit more precise in a minute, but it's a huge inefficiency. An interesting question, how many people am I talking about? The answer is, I have no clue. So a former student of mine and myself and I, we tried very hard to find any kind of data on how many contracts in the US have a cap of any given amount. How many contracts in the US have some kind of a guaranteed renewal clause that will prevent this stuff. To the best of my knowledge, there is no aggregate statistics on this, and I don't know of precise survey that would allow me. Now, if you think of it, it's a bit surprising because we're talking about a reform. The reform will try to address those kind of issues. But before trying to address the issue, it will be probably quite interesting to know the extent and the cost of this. And it's sort of surprising to realize that we don't know it, that we just don't have the kind of data that will allow us to know that. Now, how can we address this kind of issue? There is the French, or actually the Western economic solution, which is health coverage is mandatory. It's the bulk of it is government provided, and there is community pricing. So everybody pays the same price, which might depend on your age, does depend on your wage, but does not depend on your pre-existing condition. But of course, we would like to at least explore the possibility of a market solution. or actually markets, it's likely to be market plus regulation. But what would this animal look like? And that's exactly what I'm going to talk in the remaining of my talk. Now, the answer to this question, is there a market solution, is yes, because it does exist, and there are at least 2 countries in Europe, Switzerland and Netherlands, that have this kind of coverage. And I think there is plenty to learn from those examples. I'm not sure that the lesson has been integrated in the ACA, but I'll be a bit more specific in a minute. Okay, let me briefly summarize. Most of you are familiar with this, but first of all, that's exactly addressing the McGann concern that I was talking about. The ACA prohibits underwriting and pricing based on pre-existing conditions. So you're not allowed to charge a higher premium to someone who has a cancer, a heart condition, or AIDS. In addition, some benefits which are considered as essential, you're not allowed to put a cap. And in addition, there are several categories. Now, I will come back to that. By the way, the ACA, as I saw it, it's not very specific about how those 4 categories will operate, but it's something that you will have a choice, and depending on the category that you choose, that you're choosing, the amount, the percentage of the total cost that will be covered will not be the same, right? Something like this. And that's quite important. It looks like a technicality, but if you look at the way the market's going to work, it's very important. I'll come back to that in a minute. So the nice thing here is under the ACA, McGann would have been allowed to go on the market, buy health insurance at the low price. So apparently, we're in the best possible situation. We solve the problem. Well, yes, and the potential gains are huge. But at the same time, we should be extremely cautious because and that's another lesson of the Chicago economic tradition, there are unexpected consequences. And it might be the case that this kind of regulation imposed on a competitive market might have a very significant, and who knows, maybe a very negative impact on the market. Now, why should we fear this kind of negative impact? And that's something on which the economic theory has been working a lot over the last 30 years. What the prohibition does is introduce a massive amount of adverse selection on the market, and we know that markets are vulnerable to adverse selection. What do I mean? I will be a bit more precise in a minute, but adverse selection refers to the fact that we are now in the situation in which people know that they have a pre-existing condition, and this knowledge has an impact on their demand for insurance. Definitely people who know that they are very sick are much more likely to buy insurance and will be willing to buy more insurance. But the employer is not allowed to price accordingly. And those 2 facts might have an impact on the market. And this is a bit vague, but I'm going to be more precise in a minute. So my claim, let me be a bit dramatic, my claim is that if you take the worst case scenario, the market might collapse altogether. And the theory tells us this. And you might believe that it's a bit far-fetched, that I'm just trying to frighten everyone. But let's do a thought experiment. Take exactly the same question. Instead of talking about health insurance, think about term life insurance. So I'm talking about the kind of insurance in which you pay a premium, and if you die, you receive $1 million. I mean, not you, unfortunately, but your offsprings or whomever you choose receives $500,000, $1 million, whatever, right? Assume that you pass a regulation imposing that everybody should pay the same price. What will be the impact? It means that if I have a cancer in phase 4 and my life expectancy is a few months, I can go to an insurance company, pay the average price of an insurance contract, which now for a term life insurance, 5 years, coverage over the next 5 years, I'm 58, my probability of dying during each year during the next 5 years is less than 1%, so the price will be a few $1,000, right? Maybe 10,000, something like this. And for 10,000, I can buy a contract which is worth on the market, basically 1 million. And actually, when I say worth on the market, I could sell it. Now we have viaticals, right? You have a viatical is a mechanism whereby you can sell the right to some health insurance coverage to a third party in exchange for cash. So I could go to see one of those biotechnical company and tell them, well, I have this health insurance contract, this life insurance contract that's going to pay me $1 million. Unfortunately, I'm very likely to die, so I'm very likely to trigger the payment. How about you become the beneficiary and you pay me $800,000, which I happen to need for my treatment. Now, this is arbitrage in the financial term. This is something in which I pay 10, 50, 10, 30, 50,000 for something that's worth 1 million. No market could survive this. The health insurance market is different, right? So I'm not saying that this will immediately be transposed. But it's certainly true that insurance market can be harmed very severely by adverse selection. Now, a few economist remarks. First of all, competition generates price differentiation. In other words, the natural movement of competition is if people have different risks, you should price them differently. That's just because if you don't do that, someone will undercut you by cream skimming the best risk. If you charge the same price with two people with different risk, de facto you're subsidizing the high risk and taxing the low risk. But then someone will undercut you by attracting the low risk and offering them a lower premium. And so the logic of competition is price differentiation. We should be a bit more cautious here, depends on the cost, but broadly speaking, that's true. The second thing I want to talk, that's just the way the theory puts the distinction, is the notion of classification risk. There is decided that if you take any risk, you can decompose it into the probability that you're a bad risk, and then the probability of realization of the risk conditional on your classification. Let me give you an example. Huntington. Huntington is a monogenic disease. It's a terrible disease. It's monogenic, which means that if you're not carrying the gene, you will never have the disease. And if you're carrying the gene, you will have the disease with probability 1. There is some uncertainty about when it will occur, but you know that you're gonna have it. Now, there are two risks. One is the risk of carrying the gene, and then conditional on carrying the gene, the risk of developing the disease sooner or later. The second one is quite easy to cover. The first one is much more difficult to cover because, in a sense, you want to buy insurance before the risk, but the gene, there is no before the risk in this kind of genetic disease. You're born with it. So let me take a second example, and I will be a bit more precise about this distinction. The second example is a bypass surgery. Assume, God forbid, that in the next months I have a severe heart problem which requires a bypass surgery. So there are two consequences. One is there will be the cost of the surgery. I'm covered. So this will be taken into account. But it also means that for the next, until the end of my life, I will become a high risk, because the probability that I will have further medical conditions involving very costly treatment has been increased a lot, meaning that the cost of my health insurance will increase a lot as well. And that's another version of the McGann story. I will argue that there is a basic distinction between those two. Huntington is intrinsic in the sense that there has never been a moment before in which I could have purchased insurance against this risk. Whereas the bypass surgery, it's more a reclassification. Now, before my bypass, I'm not a specifically high risk, and I might be willing to buy an insurance against the risk of becoming a high risk. Exactly the same way as McGann, had he known what was ahead of him, would have been willing to buy an insurance against the risk of becoming a bad risk and being either excluded or charge a very high amount for his new disease. Briefly, the intrinsic classification risk is essentially an ethical issue. Is it ethical to charge a very high insurance premium to people because they have some kind of genetic predisposition to some disease? My wife is an ethicist, so and their interesting discussion. You can imagine what the discussion is between an economist and an ethicist. But well, sometimes economists are ethical. It might happen. Well, as an economist, I will try to reconcile them by saying, it's insurance behind the veil of ignorance. It's an old argument. But now, the way it works now is that mostly genetic discrimination is prohibited, at least for health insurance. But what's the consequence on this on the markets? What will be the long-term consequences? Well, my point is no one really knows, because this is a field that's changing extremely rapidly in a very dramatic way. In other words, until recently, those genetic diseases, there was a handful, a very small number of genetic disease, which were the kind of monogenic or polygenic, but like Huntington, which were extremely rare, and we knew exactly that there was a gene. But we were talking about less than 1% of the population. Huntington must be 1 person in 5,000 and 1 person in 10,000. That's the order of magnitude. So we had a situation in which we have a very small fraction of people at risk, and most people are not at risk. And these are the kind of situation in which insurance market tends to be robust to adverse selection. But the landscape is changing, because now the cost of a complete getting your complete DNA sequence has been decreased a lot. And we can forecast in the future that an insurance company could, in principle, know a lot about your risk. And not only your risk of those very rare disease, but risk of very common disease, like heart condition, like cancer, like diabetes, and so on, just from looking at your genes. Now, should insurance companies be allowed to do that? Again, natural tendency is to say they should not. Let's be cautious, because then we create the kind of adverse selection I'm going to talk about, and it's not completely clear that the market that was robust to the ban of genetics testing for this kind of very rare disease could still survive in the new context. Let me now talk about the reclassification risk. Think of McGann, think of the bypass example. I would definitely, if there is the risk that due to some kind of medical condition that might take place but has not yet occurred, I might become a high risk and then have to pay a huge amount in terms of future insurance coverage. That's a financial risk. I would like to cover it. So I would like to buy a contract ex ante protecting me against this. And I can. Now, what's very interesting is that if you go on the market and try to buy health insurance for yourself, there exist policies with the guaranteed renewal. So those are policies, the term of the policy is that after a couple of years, the renewal will not take into account the evolution of your health situation. So you can develop a cancer, that will not change the price. The price might depend on your age. The price might be increased for everyone in the community, like in the clients, but it cannot be specifically increased. That's the term of the contractual agreement. So that's a sort of market solution. But that's not true for employer-provided contract. Or more precisely, it's true for some employer-provided contract, but not for all. I'm covered by the Columbia Health medical coverage. This contract applies community rating in the sense that the premium I paid is completely unrelated to my health insurance situation. Actually, they didn't ask anything about my health insurance situation before granting me. By the way, there is no legal obligation for Columbia to do that. It's just the way it is. There is nothing in the current legal system that will prevent Columbia from changing the plan and deciding that all new hires will lose and will face a contract which depends on the pre-existing conditions. But Columbia is a large employer. There are several thousands of people. Same with University of Chicago. Same for the government. Same for big firms. At the other end of the spectrum, for small firms, basically there is no guarantee whatsoever. And the McGann, it's not surprisingly, McGann was in a very small firm, and that's exactly where this kind of logic applies a lot. So question, why? Why is it that the market can find a solution for when you purchase the insurance directly, but not when it's provided by the employer? What's the welfare cost? Is it so costly? What type of regulation could address the problem? And what are the potential unexpected consequences. And what I will do in the remaining 10 minutes is try to briefly answer those questions. So let me start with, can we estimate the welfare cost? And the short answer is no. That's shocking, because the ACA is aimed at solving a problem. We cannot estimate the magnitude of the problem. Why can't we? Well, first of all, we will need something like the joint distribution of risk, wealth, and risk aversion in the population. And this we have. We have proxies. I've done some work in the field. As many of my colleagues have done some work. We have some idea of the distribution of risk aversion. And by the way, all our estimates tell us that there is a huge heterogeneity in risk aversion. Some people are close to risk neutral. Some people are incredibly risk averse. So there are plenty of different attitudes toward risk, which are slightly related with income, but not much. There is a lot of heterogeneity at all income level. But the problem, as I said, is I have no clue on, I have no data on the nature of existing contracts, so I cannot. We did some back of the envelope computation, and the cost can be huge, tens of billions, maybe hundreds of billions. And the reason for that is quite simple. When people are risk averse, the cost of not being covered is much more than the expected cost of coverage, by which I mean, assume that you're facing, your wealth is, let's say, $5 million, and you have a 1% chance of losing everything. McGann kind of story, you spend 1 month in ICA, and then you have some kind of very expensive treatment, and your coverage is not following, right? How much would you be willing to pay to avoid a 1% chance of losing all your wealth? Let's say it's 5 million, but it's really, the point is really all your wealth. From an actuarial basis is 100 of 5 million, so it's 50,000. In practice, you're willing to pay much more. Most people, especially very risk-averse people, cannot imagine being drawn to poverty because of this, and they really want to do something. And that's exactly what insurance companies are there. So if they cannot get the coverage, the welfare cost can be much more than the 50,000. Or let's say the amount that they would be willing to pay in order to avoid that will be much more. So, and in addition, there is a large heterogeneity in risk and risk aversion. So it's not that everybody will bear the same cost, but there will be a small number of people who will bear a huge amount, a huge cost, which really creates serious fairness issue. Especially because we're talking about situations in which basically there are no moral hazards. There is absolutely no responsibility, no individual responsibility in being born with the wrong genes. Is it fair that you should face this risk in a way that you cannot cover? Let me talk about regulation. So as I said, the problem, all those arguments are sound, and they seem to push in the direction of regulation. But it would be a big mistake to stop there and to say the current situation is not good, so definitely we should regulate. There is this additional step. That's another point that was very much emphasized by Milton Friedman. Before saying the market doesn't work, therefore we need a regulation, you better be sure that the consequence of the regulation will not be worse than the market. And there is theory on this. We have been working on this. So you introduce a massive amount of adverse selection, because agents know their pre-existing condition. This has an influence on their demand, but insurance are not allowed to differentiate. And especially this creates two kinds of dangers, the so-called death spiral and the self-selection. Let me briefly explain what those are, and you will see that it's completely commonsensical. And then I will conclude by asking what are the dangers. So what's the death spiral? So remember, if I charge everybody the same price, irrespective of the pre-existing condition, I'm subsidizing possibly quite a lot the high risk, and I'm taxing possibly quite a lot the low risk. Now the problem is the healthiest people, they are the ones who are taxed, might decide that health insurance is too expensive, I don't want it. But then you're left with the less healthy people. So the cost increases. If the cost increases, you have to increase the price even more. But by increases the premium, among the people who are left, the healthiest among those who are left are more likely to leave, and so on and so forth. And you might have a complete unraveling of the market. That's the motivation, the explicit motivation, the ACA for monetary insurance. It has nothing to do with paternalism, but it has to do with the fact that we want to avoid the death spiral. The problem is, first of all, on the one hand, we are not sure that there will be this kind of death spiral. You look at the model, they tell you it all depends on the distribution. There are plenty of situations in which you don't trigger a death spiral, and almost everybody remains insured. Are we in a situation in which the death spiral could be a likely outcome? We don't know. And if we're in a situation in which the death spiral is a real threat, to impose the mandatory coverage, there are fines. Are the fines sufficient? Or are we in the situation in which the fines are so small that the death spiral will take place nevertheless? Well, the answer is no one really knows. I don't know of any kind of serious studies dealing with this issue. And it's difficult. But the other aspect, which is selection, which is even more subtle, that's a contribution by Mike Rothschild and Joe Stiglitz 40 years ago, actually. What does competition under adverse selection look like if you impose coverage? Well, you're an insurance company. You know that people are very different. You know that Eddie Lazier is in much better health than I am, so you would like to charge me a higher price than what you charge to Eddie, but you're not allowed to ask me my medical records. But you know that I know. So how about you face people with a menu of contract? The menu of contract will be something like, there are some contracts which offer full coverage. Basically everything is paid, but the price is very high. And then there are coverage with large deductible, or covering only 50% of the cost, whatever. But the price is much lower. Now, if I know that I have a pre-existing condition, of course I will go for the full coverage one. If this works and people self-select, I can price accordingly, and I can price the high coverage contract a very high price just because I know that the people applying to this will be the worst people in the population. And by the way, that will be fair pricing because at the end of the day, you look at the population actually buying this contract, the price will be actually, the price will be fair just because only the very unhealthy people will go for that. So at the end of the day, you might end up in a situation in which the level of price discrimination will be pretty much the same as you would have without the regulation. In other words, people with pre-existing condition will pay much more. And with the additional cost that low-risk people, instead of being fully covered, will have only a partial coverage. And they need this partial coverage to signal the fact that, okay, so are we going to be in a situation like this against? We don't know. To the best of my, and that's a very serious concern. We've seen things like this. I've been working on in other markets, in particular automobile insurance, annuity market, and so on. We've seen things like this. Will it be the case? We don't have any study. Their impact on employment, I will be very brief on this, but it will change labor supply. It will change productivity. And here the message is probably good. There seems to be some evidence that people who are covered are more productive than people who are not. It's always difficult to distinguish selection into coverage from the direct impact, but there seems to go in this direction. Probably the most complex effect, but possibly the most important, will affect matching. The recent literature on labor economics emphasized the fact that people have different skills, but companies are extremely different. And what's going on the market is a lot of matching, whereby the most productive people go to the most productive firms. Now, this is extremely efficient. If you compare the situation that you get with this assortative matching with what you would get if you randomly allocate workers to firms, which was pretty much the case in the Soviet Union, for instance, you see huge differences in production and productivity. But then if you believe in this kind of logic, you want people to select the firm based on their ability and not based on the kind of contract that they're offering. You don't want very gifted people go to apply for a position in the call center just because there is a 500,000 cap on their house insurance. So this should be taken into account. Now, so let me conclude. I realize my talk must have been somewhat frustrating because I've kept asking questions. I didn't give you many answers. But first of all, crucial issues seems to be underestimating the design of the policy. I didn't see much regarding the adverse selection. The only thing that was mentioned explicitly was the risk of the death spiral. I didn't see much about the selection problem. And what's very surprising is the lack of precise empirical studies. Now, there are papers now. There have been studies of the Massachusetts reform, as you know, that was something like a precursor, and we have some information like this, but Massachusetts definitely is not representative of the United States. And I mean, I think you would believe me. You will agree with me on this. Those are a couple of very interesting recent papers, not yet published. This one is about the risk of adverse selection of the kind I described, and this one is about the impact on the labor market in terms of matching and so on. But you know, what's very surprising is, first there is the reform, and then there are studies trying to assess what the consequence will be. You would have liked the opposite, that you start by doing reforms, by doing the studies, you have an assessment of, and once we're talking about big scale reforms here, the potential damage can be huge. You would like to think that people try to know as much as they can before implementing the reform. Apparently that was not the case. We had examples like the Swiss case, and not much has been said about the Swiss case. If I have 1 minute more, let me tell you a story, an anecdote about the Swiss case. Years ago, in another life, before I came to the U.S., I was in Paris, but I spent some time as a visiting professor at the University of Lausanne in Switzerland, and they have an extremely good group in health economics. And so they were talking about the main issue about the health insurance system in Switzerland at that time, which was the following. So they had exactly the same system as the US, namely competition with a regulation imposing community pricing, prohibiting the use of pre-existing condition. The logic is clear. The logic is both Eddie and I are client of the same insurance company. Eddie is a high risk, he's a low risk, I am a high risk. So essentially the insurance company is losing money on me, making money on Eddie, and on average, it can break even. Well, that's fine. It's still the case that if they could get rid of me, get rid of all the Chiapporis, and concentrate on the submarket of all the Laziers, they will be much better. Now, one way, as I said, is to offer menus of contract. This has been regulated away in the Swiss case. They realized this risk and they regulated away. The next problem, the next step would be, they cannot kick me out because that would be illegal, but they can try to discourage me. And actually, the problem the Swiss had was a situation in which some people had a hard time finding an appointment. The appointment will systematically be canceled and postponed. Their files will be lost. I mean, plenty of administrative glitch that made their life very miserable. And at that moment, they're going to say, the hell with this insurance company, I go to another one. The cost of moving is zero because the price will be the same at the other company. This is regulated. But so essentially we had companies actively engaging into making people's life miserable just to get rid of them. That doesn't, but that's could be a logical outcome of this. Now, the way the Swiss were trying to address that is by creating a compensation scheme, global compensation scheme, whereby any company covering me would receive some money as a compensation for the high risk that I'm representing, and the fund will be funded by companies insuring Eddie. Since his health is better than average, this company will pay something to the fund. Now, I don't see anything like this, and it's quite different from the exchange. So again, I think there would have been plenty of things to learn from the example of other countries, and those opportunities, I think, have not been seized. I've been too long, and I'm more than happy to answer your questions. Oh, please, if you have questions, please ask for a mic, because the thing is recorded. So where are the mics?
On the side.
Would you mind going to the mic? Apparently the mic doesn't come to you, so you'll have to come to the mic. Sorry about this. The whole thing is recorded, so we want to record the questions as well.
It's like the insurance system is not flexible. I can't believe how difficult this seems to be, because we have in Europe a lot of national, insurance schemes that have populations. Yes, they're maybe half a generation behind packaged food consumption as we are here, but roughly the data can't be that difficult So I'm a little bit mystified about why the U.S. can't take German or French data for all of these buckets of patients and create the solution. What's the problem?
Oh, yeah, that's a very good question. The problem is the French system is a system in which what you pay does not depend on your health situation. So the crucial question, which is how much more willing would you be to buy an insurance due to the fact that how much more would you be willing to pay to buy insurance due to the fact that you know that you have a pre-existing condition? You cannot see that on the French data because we don't have the price differentiation. In principle, you could use Swiss data, or you could use and actually you could go to my colleague at Lausanne and see the kind of stuff that they have been doing. Definitely, you would expect the U.S. population to be quite different from the Swiss. So, and the problem with this kind of model is that whether or not you will have a total unraveling of the market due to the death spiral or due to the selection stuff depends. It's very sensitive to the parameters. You have some parameters for which you expect it to happen, some in which you don't. So if the parameters are different in Switzerland and in the U.S., in principle, even in the U.S., you could do things. For instance, you could run experiments. You could try. It's my perception here is it's very difficult to get those data, but it's not impossible if there is really a willingness to do the kind of preliminary studies in a serious way, and that was not done. And you know, I'm not naive. The political process is not one in which you can come and you have a big reform that you announced as a candidate, and then you tell people, well, let's spend 5 years doing studies, and then we'll talk about it. It's not like this. So I'm not saying that politically it was feasible, but this is how I see the.
So I appreciate the comment you made in terms of policy versus study, because, I mean, if you don't implement something, regardless of how flawed it might be, you're never going to actually get momentum. So I want to ask you a question with the concept that first, you know, given like the death spiral, we need to recognize that anybody that's uninsured in America, if you look at the whole system, we pay for those individuals through our taxes anyways, right? So if we then kind of chunk the system up and say, okay, let's look at just healthcare expenses. And I'm wondering if, because you introduced yourself as someone looking at insurance in terms of like a financial product, as opposed to actual healthcare or health insurance in terms of risk management. Because I think all of a sudden you start changing the dynamics there. That being, I'm going to go to the toy industry, right? Usually you have a consumer and you have a producer, right? You have a producer of goods and you have a consumer, someone who walks into a store. Well, with the toy industry, maybe you change that model because you have children that walk into a store and they want something, right? But it doesn't mean anything to them. And ultimately you have this agent in between, you have the parents, and they're the ones that now kind of control that flow. Because in terms of certain aspects of ACA or even certain aspects of MAPD and other Medicare, Medicaid type programs where it's now risk management as opposed to more of a traditional insurance financial product. If some of your tenants here this evening can apply to this model where, one, we're assuming everybody's going to be insured. In other words, we as a community, we are going to ensure that everybody has a certain level of quality of care. And two, that supply demand is actually going to go to the insurer to where if we know based on people's genes, for example, they are going to tend towards a much more expensive path, that all insurers are given a certain amount of premium, and then it's based on how they manage that risk, or even manage the individual's expectations of what their quality of living is going to be. And this is where we start getting into more of like a cultural Europe versus US, how long I think I should live kind of concept. But I'm just interested if, you know, when you think of this on, you know, from insurance versus healthcare, if you think it can actually be applicable to what the actual system in America looks like.
Well, it's first of all, again, I'm not a health economist, and many of the aspects you are alluding to are investigated in the health economic literature, in particular the organization of care and so on and so forth. And I agree with many things you said. For instance, my colleague and friend Amy Finkelstein used to say there is already a universal insurance system in America. It's called Medicaid. And there is a deductible, which is your entire wealth. So in other words, if you have a problem and you lose everything, once you're left with nothing, you can be covered by Medicaid, and of course the cost of this is likely to be very high. So my wife, as I said, she's a medical ethicist and she's working at the University of Columbia Hospital. Another aspect is you see plenty of people who are not covered. They show up in emergency rooms. They are taken care of. Thankfully, I mean, we're not in a country in which people die because they cannot be treated, but they tend to go to the hospital way too late. And of course, it means that it costs much more. Now, it's even worse because if you put that and in addition, you put Medicare, and think about the incentives of prevention. And that's related to your toy example. So there are the kids, and they want everything. There is the seller. We like to sell them everything, but in between there are the parents. So who are the parents in our healthcare system? You could say it's the doctors. They are the doctors, and to some extent it might work. But one of my friend used to say, if you ask your doctor how much you should spend on healthcare, it's a little bit like asking your butcher how much red meat you should eat every day. The answer could be slightly biased, but it could be the insurance company. So it could be this kind of. But so in particular in prevention, you would.
Well, we're a balance though, right? Because parents don't want their children to mutiny, but they also want to keep them happy. So it's that balance between the provider and
so it could be the same balance could be the insurance company, they don't want to spend too much, but they don't want the client to be too dissatisfied. So and in particular, one thing you would expect is they should invest a lot in prevention, because we know that if you invest in prevention, it reduces a lot the cost in the future. And from a total expenditure viewpoint, it makes sense. The problem is if you invest in prevention, it costs you something now, and there will be plenty of money saved down the road, but that will be saved for Medicare. Because when those kind of treatments that you have not, when those kind of disease that you have not prevented will realize, most of the time people will be more than 65 and they will be covered by so the incentive to create prevention are not there. Now, I don't want to talk too much about this because this is really beyond my scope of competence. As I said, I'm not a health economist, and my colleague health economists work a lot along those lines. But those are very important questions. I'm just talking about just one aspect, which is really the insurance. But my main message here is you can go from one extreme, which is the Western European, which is it's covered by the government. Then you can price as you want, but if you want a market solution, it's feasible. It's extremely complex, and it requires a lot of regulation. People complain that there is too much regulation in ACA. I would think there is not enough regulation. That there is an additional layer. You should regulate the contract. You should regulate the size of the deductible, and so on and so forth.
The question that I have is this. How do we quantify the costs? For example, in the Wall Street Journal today, there was an article about how much it would cost to redress a brain hemorrhage in different parts of the country and in different hospitals. It was all over the map. Yeah. So do the insurance companies have the data on what costs actually are? Because none of the rest of us have them.
That's a very good question, and here I will plead not guilty. That's exactly the kind of question that health economists have been looking at a lot. So I don't want to answer. Really, you should invite someone who's a health economist and work on the cost. But let me give you just my personal experience. I have a medical condition which is not very severe, but for which I have a treatment on a regular basis, and so I do it mostly in the U.S., but sometimes I have to do in France. And the same medical act, which costs $200 to $300 each time in the U.S., costs $30 in France, 30 euros in France. And you see, but then what does $300? Because there is the official cost $300. But the negotiated cost with the healthcare company is 1/3 of this. So if you show up without no coverage, you will be charged $300. But then no one is paying exactly those $300. So there is a lot of opaqueness. But there is a lot of work by health economists in particular looking at the economics of including using data from the hospitals. So why don't you invite a top health economist, which we would talk about this, and those are very important issues.
So, sorry to interrupt. Just do some research on reference-based pricing, and it'll answer her question to some degree. I don't know if you've heard of that.
The
reference-based pricing.
Yes. So that's and by the way, that's a solution. This concern that the costs are spiraling up also exists in Europe, and it's also used. This kind of reference pricing are also used in Europe. It's fair to say that it's not so easy costs are increasing everyone, right? The rates, there are two questions. One is the level, and the other one is the rate of growth. The level is much higher in the US than in Europe. I'm not sure that the rate of growth is much higher in the US than in Europe. But this is due to exogenous factors, due to, for instance, technical progress. It can be due, but again, I don't want to talk about this because I'm not competent enough. The traditional Chicago, you talk about things that you know, and there you're far beyond my ability.
I've also wondered about this potential for skimming the cream strategies with the new systems, and the one angle that I have no information on but curious about, maybe you know, maybe somebody else does, is how hard it is to declare oneself a Christian Scientist. And my guess would be that there's a tremendous surge in membership or enrollment in Christian Science, becoming a religious, my assumption is one can be a religious objector to the whole system and opt out of insurance. And it would seem that if somebody could figure out how to provide a backstop protection plan for Christian Scientists, it might be the very way to provide a lower grade policy. I'm not just being facetious here.
No.
I do wonder if there's going to be those who choose to self-insure or those who, either by virtue of personal wealth or to opt out, if that's a meaningful opportunity.
Yes. This notion of the link between religion and health practices is completely fascinating. From this, again, you should not invite me, but you should invite my wife. She has been working on this. Not that I'm trying to push my wife by all means, but she happens to do. She has not worked on Christian Scientists, but let me mention one thing that she has been doing, which I found quite fascinating. Jehovah's Witnesses. They don't accept any kind of blood transfusion. Now, it's very interesting to see the reaction of the medical system in Europe and in the US, and particularly in France. France is a country in which, rationality should be put ahead of everything. So those people, they are crazy. We don't want to hear about them. They don't want the transfusion. That I could not care less. If they need a transfusion, I will do the transfusion at the end of the story. Which, from a democratic point of view, is not very respectful of people's beliefs or anything. Here in the US, there is this kind of, which goes with competition. I think that's another message from Milton Friedman, that competition does a lot to promote democracy in the sense of respect for different beliefs and everything. Now, what happened here in the US is that they took those demands seriously, and they started to develop new surgical technique that would allow you to do a bunch of surgery without the need of transfusion. And it's completely different. It's more costly. But on the other hand, the Jehovah's Witnesses are in much better health situation. They don't drink, they don't smoke, and so on. So altogether, the company who developed that managed to make profit. And at the end of the day, the bloodless came the AIDS epidemics, the mad cow, all those kind of blood-transmitted disease. And it turns out that the technique that have been developed just because people wanted to respect those kind of religious beliefs of Jehovah's Witnesses happened at the end of the day to be extremely favorable to everyone, because it became very important to be able to do surgery without doing the transfusion. So it's a fascinating topic. I don't know if it's easy to get data about Christian Scientists, by the way.
But I actually didn't mean it so literally. I meant them gaming the system.
I know.
Oh.
Word.
Okay.
I'm going to let this gentleman who's been standing very politely, waiting for everybody else.
Okay.
First one, usually to
My question is kind of simple. One of the variables that relates to risk and regulation relates to the fact that we're dealing with an aging population. And could you extrapolate on that?
Sorry, can you?
We're dealing with an aging population, and obviously that factors into risk and regulation. Could you address that?
We're dealing with a what?
Aging.
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 Oh, yes. Well, yeah. Technically, it depends. It depends on one thing. There are two issues here. One is, in the regulation, do you allow price differentiation based on age? Let me remind you that the price differentiation based on gender is controversial. And actually, there has been some new regulation in Europe prohibiting the usual. Now, so the kind of first order response would be, if the regulation can be based on age, then probably that might mitigate the problem because it will be taken into account. So it will not enter into the adverse selection mechanism. But in addition, more and more people will be covered by Medicare, and Medicare is a French type of system or a European type of system in which you can do community pricing because you don't have those issues of competition. So the paradox is the aging population will have a negative impact on the total cost, but paradoxically, you might expect that it might alleviate the adverse selection aspect. Again, this is completely speculative because we will need explicit studies. So that kind of my gut reaction, take it for what it's worth, which is not much. We don't have studies that allow us to answer precisely.
Thank you. Well, you can see why my introduction was not overstated. That was an incredibly lucid presentation on a very difficult set of topics. Thank you very much, Pierre-André, and hopefully you'll agree to come back next year and give us your latest thinking on the issues. We are adjourned. Thanks for coming, everybody, and hope to see you again.